Good morning and welcome to the Morning Bell. I'm Robert, joined by Lizzie and Steve. It's Friday, May 22nd, 2026, and we're closing out a week that's seen the S&P 500 on track for its eighth consecutive weekly gain. Lizzie, what are the main themes you're seeing in today's news?
Thanks, Robert. The dominant narrative continues to be this AI-driven momentum that's pushing markets higher. We're looking at the S&P 500 approaching its longest winning streak since 2023, and it's almost entirely fueled by artificial intelligence enthusiasm. Meta just announced they're reassigning 7,000 employees to AI teams while cutting 8,000 jobs overall, which shows how serious these tech giants are about pivoting resources. But here's what's interesting from a trading perspective. We're also seeing some significant warnings emerging. Bank of America's Hartnett is cautioning that mega IPOs could create a bubble reminiscent of the Roaring Twenties, and there's a hedge fund calling out a toxic cocktail of factors that could push the S&P down 15%. Meanwhile, geopolitical tensions are heating up again with oil prices rising on doubts about US-Iran peace talks, and that's pushing gas prices to nearly four-year highs just ahead of Memorial Day weekend.
That's quite a contrast between the AI euphoria and these warning signals. How are you reading the market's interpretation of these competing narratives?
Markets are clearly choosing optimism over caution right now, but that selectivity is becoming more pronounced. The AI rally is real, but it's also narrow. Nvidia just announced one of the biggest buyback programs ever, which is supporting sentiment in that sector. But we're seeing some cracks elsewhere. BJ's wholesale earnings showed that cheap gas actually matters for consumers, which tells us people are feeling pressure. There's also notable corporate activity with CVC launching a €10.9 billion offer for Italian drug maker Recordati. So M&A remains active. From a trading standpoint, the key is recognizing that this market is rewarding very specific themes while punishing others. The energy sector is getting a bid from geopolitical risk. Tech continues its AI-driven run, but consumer discretionary and anything sensitive to gas prices is facing headwinds. The risk-reward is getting skewed after 8 weeks of gains, so position sizing becomes critical here.
You mentioned the technical picture. What are the indices telling us heading into the weekend?
Looking at the technicals, the S&P 500 is in a clear uptrend, but we're reaching stretch territory. We're testing resistance levels that, if broken, could push us another 2 to 3% higher. But the momentum indicators are showing divergence, which suggests caution. The Nasdaq is even more extended, given its heavy tech weighting, and it's benefiting disproportionately from the AI narrative. We're seeing strong support around current levels, but a pullback of 5 to 7% wouldn't be surprising, given how far we've come without meaningful consolidation. The Dow is actually the most interesting because it's lagging, which tells you this isn't a broad market rally. It's concentrated in growth and tech. For traders, I'd be watching the S&P 500's ability to hold above its 20-day moving average. If we break below that with volume, it could trigger some profit taking after this 8-week run. But as long as we're above it, the path of least resistance remains higher, at least in the near term.
That selectivity is going to be key for anyone managing risk here. Steve, let's get into the economic picture. What's the data telling us about the underlying economy?
Thanks, Robert. We're in an interesting spot economically because the data is sending mixed signals, and that's creating some uncertainty about the Fed's next moves. Earlier this week, we saw some weak U.S. macroeconomic data that would normally pressure risk assets, but markets largely shrugged it off because the AI narrative is so dominant right now. What's concerning from an economic perspective is that consumer spending data is showing strain. We saw evidence in the retail sector that high gas prices are impacting purchasing decisions, which makes sense given we're at nearly four-year highs for gasoline ahead of the Memorial Day weekend. The labor market data we received earlier this month showed some softening, though we're not seeing anything alarming yet. Initial jobless claims have been creeping higher over the past few weeks, which suggests employers are becoming slightly more cautious. On the inflation front, we're watching energy prices very carefully, because if oil continues climbing due to Iran tensions, that could reignite inflation concerns just when the Fed thought they had it under control. Next week, we're looking at some housing data that will be important, particularly existing home sales and new home sales figures. The housing market has been one of the more resilient parts of the economy, so any weakness there would be noteworthy. We're also getting durable goods orders, which will give us insight into business investment trends. The bigger picture here is that growth is moderating but not collapsing. Inflation pressures are mixed with energy being the wild card, and the Fed is likely in a holding pattern trying to assess whether this slowdown is healthy normalization or something more concerning.
Given that economic backdrop, Lizzie, let's talk crypto. What are the trends you're seeing in digital assets heading into next week?
The crypto market is showing some fascinating divergence right now, and Bitcoin is actually in the strongest position of the major coins. We're seeing a 90-day uptrend that resembles classic bull market behavior, and there's renewed momentum behind the strategic Bitcoin reserve concept, with US lawmakers pushing the Armor bill that would include a 20-year lock provision. The technical picture suggests Bitcoin could rally toward $80,000 to $82,000 based on liquidity analysis, though we need to watch that $76,000 support level carefully. Long-term holder supply is approaching record highs above 15 million BTC, which historically has been bullish because it reduces selling pressure. Trump media moving over 2,000 Bitcoin to Crypto.com is another signal of institutional confidence. However, there are some caution flags. Coinbase Premium is at monthly lows, which suggests institutional demand isn't as aggressive as retail enthusiasm. We also saw realized losses jump to $600 million, indicating some profit-taking. Mark Cuban made headlines selling 80% of his Bitcoin holdings, saying the hedge narrative disappointed him, which could influence sentiment. For Ethereum, I'm actually quite bearish heading into next week. Harvard dumped their entire ETH position after just one quarter, which is a major red flag for institutional confidence. There's talk of an identity crisis deepening with high-profile departures from the ecosystem, and US sanctions on cartel-linked Ethereum addresses are creating regulatory overhang. Ethereum funds are seeing outflows while XRP ETFs are attracting inflows, which shows money rotating away from ETH. Solana is the interesting opportunity here. It's testing double top resistance, and if it breaks above $100, there could be a nice momentum trade. It's benefiting from being an alternative to Ethereum as that ecosystem faces challenges. The big event next week is a $1.9 billion options expiry across Bitcoin and Ethereum, which typically creates volatility. Overall, I'd say Bitcoin is cautiously bullish with an $80,000 target. Ethereum is bearish until we see institutional confidence return, and Solana offers the best risk-reward for traders looking for short-term opportunities.
That's a comprehensive look at where we stand as we head into the weekend. The tension between AI-driven market momentum and emerging economic pressures is going to be the story to watch. Whether this 8-week winning streak extends or we finally see some consolidation will depend on how these narratives evolve. Remember, do your own research and consult with financial advisors before making investment decisions. If you found today's discussion valuable, please subscribe to the Morning Bell so you don't miss our daily market analysis. I'm Robert, thanks to Lizzie and Steve, and we'll see you next week.